Now, what causes this, the second sell-off here that you think is going to be the catastrophic event with the bank failures and such? What do you see? You
Yeah,
mentioned.
it's I think part of it is going to be um, a, a Fed policy misstep. So let's say you get to my 42 to 4,500 on the S&P. So let's say we've run the market up, 1,000 points plus. Um, everything, you just came through a 30% plus GDP print, and everybody's ebullient and talking much different than they are now, and talking about this thing finally where we got, let's say we get a vaccine of some sort that looks promising. Um, and all of a sudden you're going to have an awful lot of people saying, okay, we had our bad times, good times are here now, and they're going to roll on. I think with all that money sloshing around out there, the Fed's going to become very worried about the excessive risk in the market, and probably do more than just the pause we saw this summer, and maybe step back a little more aggressively than that. And if the Fed pauses, I think this thing could unwind very fast. And let's remember, this is a global bust. So it may not even be the US that's the main problem next year. It may be Europe. It may be, some mistake in Asia. There's so many problems out there because of what the virus has done across the globe, that I just think it's unrealistic to think we go merrily along. And if the central banks, who, let's face it, we entered this cycle, when the Fed had the problem back in 2008, October 2008, they grew the balance sheet to 800 billion. Now we're at 7 trillion. Of course, any central banker is realizing that we're way beyond anything this is unprecedented. So they're going to be at any chance that they see that they've gone too far, they're going to be sensitive to be pulling it back. So that's why I think you could see a policy mistake combined with just kind of the fact that busts happen over time. They don't all happen in a few months. So the second phase of it is because you had a respite, and then the wave comes back at you.